Hi, everybody. Welcome to this month's episode of Elevánt Wealth. It's easy September 15th, and also that this is our 34th broadcast or episode of Elevánt Insight. And our today, Matty DiFerdinando. I apologize, Matt, but we met Matt about 3 years ago, and he's been doing something similar in his world, and we started him in November of that'd be 2022. So appreciate having him on board with us.
I think we might need to dedicate our webinar series to Matt. I think he was kind of the original idea behind doing this because you've got a great webinar that you do. So thank you, Matt.
Oh, no problem. Hey, the more education we can provide to clients out there, I feel like everybody would agree that there's financial topics are an underserved educational piece in the United States. They don't teach it in school. So it's really on the financial advisor. So kudos to you guys for providing education to your clients.
Well, thanks for your information. One other quick note, kind of on an Elevánt Insights platform that I wanted to just mention. I want to remind everybody what the word Elevánt means. It comes from the Latin word elevare, which means to raise or lift up to a higher plane. I would just encourage all of us in today's world and our environment that we focus on our attitudes, our kindness, and how we treat one another, that we rise to the occasion and lift up everybody, that we're kind and compassionate in the world that we live in, and we have those challenges that in front of us, that we take the time to be kind and move forward in the way that would be respectful of one another. With that said, let me go ahead and introduce Matt. He's a senior vice president with Blue Rock Capital in the Pacific Northwest. Matt's been a senior vice president for Pacific Northwest for, I believe, the last 12 years. He's originally from Philadelphia. He's really happy that the Eagles won the game last night, and he graduated from the University of Pittsburgh with a major in finance. Matt really enjoys, as he mentioned earlier, providing education in the real estate market to financial advisors and their clients. That's what we're going to focus on today is real estate. So with that, we'll go ahead and turn the time over to you, Matt.
All right, Dan. Thank you. Brian, thanks for having me. As I mentioned, my job is I work with financial advisors, and I probably work with 4,000 financial advisors across the Pacific Northwest. And you two are two of the only advisors that actually do continuing education for your clients. So if anybody's watching this, kudos to Dan and Brian, because not many advisors are doing this. So good job by you. So what I talk about every day with clients and financial advisors is all of the benefits of real estate. So of course, with real estate, you get three key benefits of including real estate in your portfolio. Number one, it's an income generator because real estate is producing real dividends, real income from rents coming in. You also get appreciation. So ideally, over a long period of time, the real estate's going up in value. So you have that 1-2 punch of getting income plus growth. And then last but not least is there's a lot of tax advantages with real estate. So a lot of folks that have wealth in the United States, they'll use real estate as an investment vehicle because it allows you to minimize your taxes. You're able to use all of the depreciation, all of the amortization, all of the costs associated with real estate to lower your taxes. So for example, on a $100,000 investment, if your dividend was $5,000 for the year, 5%, typically on average, it could be more or less, but on average, about 2/3 of that dividend is going to be non-taxable each year. It's going to be tax deferred because you're getting all the benefits of depreciation and amortization. So if you want an update on all of the tax advantages of real estate, definitely reach out to Dan, reach out to Brian. Another topic that comes up all the time is investment real estate. A lot of folks out there own investment real estate, whether it's a rental property, whether it's business real estate, whether it's vacant land that comes up all the time. If you are tired of managing your investment real estate, if you're sick of dealing with the tenants, the time, the taxes, the toilets, the termites, if your property taxes are going up and your insurance costs are going up, reach out to Dan and Brian. That could be worth a conversation, because you can do a tax-free exchange from an investment property that you own into a property that's managed by a large financial institution. And the benefits there is it could potentially increase your income, but also it could decrease your workload and it could decrease your stress. One example would be, we were just looking at $1 million rental property, and they were collecting $30,000 a year, but their mortgage was $18,000 a year. Their property taxes were $6,000 and their maintenance was $3,000. So when we added it all up, they were only making $1,000 to $2,000 net of all the expenses on $1 million investment property. If they were to execute what's called a 1031 exchange, a tax-free exchange, into a professionally managed property, it could potentially bump up their income to somewhere in the neighborhood of $30,000, $40,000, or $50,000 instead of just a couple $1,000s. So just wanted to point that out. If anybody in your family, friend, family, coworker, parents own an investment property, reach out to Dan, reach out to Brian. It might be worth evaluating if you can potentially get more income, but also, reduce your stress and anxiety. So I'll stop there for 1 second. Any questions on that, Dan or Brian, in terms of the investment property?
I don't have any questions on the investment property. Might just spend a little bit more time on what the 1035, that would really look like, how it qualifies. Not a lot, but just maybe go through that.
Well, and I can speak to that real quick, Dan, and also Matt, just to confirm, we actually had a client just recently that we helped them do the math on what their actual rate of return was on their money, if you will, like their actual cash on cash return for the money they had invested in a real estate property. And again, due to property tax increase and their own personal hesitancy to increase rents as inflation has gone up around them and insurance costs have gone up around them, that's really what caused this issue. And so when we looked at the math, it was like 1, maybe 2% that they were getting on this millions of dollars that they had tied up in real estate. And it led to a decision, right, to do some liquidating and to navigate the tax aspects of that using a 1031. So the 1031 exchange is pretty simple, and Matt, you can correct me if I'm out speaking off at all, but it quite literally is the IRS saying, hey, if you'll keep real estate for real estate, then we'll allow you to keep your original basis. In other words, what you originally paid for the property, we'll let you to keep that and roll it into another property. So if you've got a property that's worth a couple $1 million, but you only paid $100,000 for it because you bought it a long time ago, then you'll keep that original basis, but you won't pay any gains on buying the new property. You essentially get to roll it into the new property and continue to let that grow without having to pay tax. I've found that it works really, really well for legacy type real estate, where you're planning on keeping that real estate as long as you live. And so then what you do is you defer, right? You keep pushing that tax out. And when you pass away, your family receives what they call a step up in basis. So they inherit it at the value that it is the day you passed away. Hypothetically, if they sold it right around that same time, there's no gain from their basis with the step up and their current value, and nobody ever pays that tax. And so I think 1031s don't always make sense. Like if you see yourself liquidating that at some point in the future, it might make sense to pay the tax now, just simply because we're in historically low tax brackets right now. And it might make more sense than trying to kick the can. But if you're planning on keeping a portion of real estate in your portfolio forever, then this could be a great opportunity to kick the can on the taxes until you pass away and leave those real estate assets to your family, and then nobody pays taxes. So did I miss anything there, Matt?
Yeah, no, you hit the nail on the head. we see it all the time, $1 million investment property or business property. Client wants to sell it, but they don't want to pay tax on the $1 million. So what they do is they sell it, the money goes into escrow. That money is then used to purchase a replacement property. Like you said, it has to be an investment property. And by doing so, you can then, essentially not have to manage this property anymore. Now you're investing in an institutional property, but the key is you don't have to pay tax on all of that gain. You don't have to pay tax on that $1 million of gain. So I would say for simplicity, if you have any investment real estate that's appreciated, definitely talk to Brian and Dan, and they can do analysis on if you could potentially increase your income, but also could you potentially increase your time and reduce your stress and anxiety is the key.
I think also it'd be important to just point out if we're doing those 1031s from appreciable property into a professionally managed portfolio of real estate, again, the cost of maintaining all those things is no longer there. It's just a lot simpler process. You're not having about rent and all those other things that go with being a landlord or owner or farmer or whatever it might be.
Yep, that's exactly right. And same thing with business assets. We just had a dentist in Idaho, and he's retiring. He owns 3 buildings. So in retirement, he doesn't, he sold the buildings to the next dentist that's going to be taking over there, right? So rather than having to pay tax on that $5 million, he can then sell it, take the money, use the proceeds to invest into an institutionally managed property. And now he doesn't have to pay tax. He can defer the taxes on that $5 million. But anyway, there's just a lot of real life scenarios that would apply to on the 1031 exchange.
It's really interesting too, when you look at, say that, let's use that example, like the $5 million after taxes, let's call it 3 or 4, right? Let's call it 4 for easy math. Well, what investment return can you get on 4 versus if you defer the tax, what investment return can you get on 5 if you keep it, a tax-free exchange? So you actually don't have to get as high of a return on the real estate property as you would outside of that for it all to be even, because we're keeping all of our money, right? We've got more money working for us. And so anyways, that kind of math is really kind of fun to do. And just figure out, if something like this makes sense.
Beautiful. Well, that was idea number 1 that we wanted to cover was the 1031 exchange for anybody that owns investment property. And then idea number 2 would be gaining access to private real estate, which is typically only available through financial advisors. It's not going to be available on your public trading platforms, the Fidelities, the Schwabs, all that good stuff. So is it cool if we switch gears into kind of topic number 2 there, Brian and Dan?
You bet.
All right. So typically, if you're watching this, financial advisors are going to have access to investments that aren't on the public platforms. Things like private real estate. There are real estate funds out there that are only available to large pensions, institutions, endowments. This is very high quality real estate that's, typically highly occupied, high income producing. It's going to be lower risk real estate compared to what's available on the public platforms. And then Brian and Dan, they typically will have access to investments from sponsors like Blue Rock and other sponsors that will buy shares into these private real estate funds that we don't have access to. But then through a sponsor like Blue Rock, we're buying shares into these funds because we can do that as an institutional investor. And then Brian and Dan, your good clients can invest in funds like Blue Rock so that they have access to the same exact real estate that the large players have access to. You can literally invest in the same real estate that Harvard's investing in, Yale's investing in, the police pension, the firefighters pension, all of that good stuff. So why would we want to invest in private real estate? Well, right now, about 45% of all the investable money in the United States is in cash and bonds. So if we look at cash, CDs, savings accounts, money markets, and bonds, That's almost half of all the investable money in the United States. And as we know, cash and money markets and CDs and bonds, most of those investments over the last 15 years have averaged like 2 to 3%. Now, rates might be a little higher right now. Maybe you can get 3 to 4. But historically, we're looking at like 2 to 3% over the last 15 years, whereas private real estate's average closer to 8.5 to 9%. So what you see is a lot of the large institutions like banks, insurance companies, and pension funds, they'll invest in high quality real estate so that they can earn 8, 9, 10%. And then specifically, if you're a bank, they'll actually turn around and pay their clients 0.5% in a savings account. So they're investing all the money that they have and getting 9, they're paying you 0.5%. So I always say, hey, why not do what the large institutions are doing, right? Because we could potentially, obviously no guarantees in the financial industry, but if we look historically, you could potentially earn a higher rate of return. So let me just dive into some long-term numbers. This is right off of our public website. This is available to everybody. All you have to do is just Google the Blue Rock Total Income Plus Real Estate Fund, and it'll take you right to our client-approved website. And if we look at the history of private real estate, they've been tracking this asset class for 46 years. 46 years. And what we can see is if you put in $10,000 46 years ago, it would be worth $458,000 today, assuming you were reinvesting all of your dividends. That's almost a 9% annualized rate of return. And just the income alone from rents has averaged about 6.7% per year over the last 46 years. So remember that combination of income plus growth. You get, with real estate, you get your dividends. And then when you factor in your appreciation, on average, you're looking at about a 9% annualized rate of return going back 46 years. Now, in terms of timing, what we can see here is there's been only a couple down periods of time in real estate. 2008, real estate was down. But if you look right now, when the Fed increased the Fed funds rate from 0 to 5.5%, that reduced the value of real estate. So when rates go up, the value of real estate goes down. So if you are ever looking at a good entry point for real estate, we think that now is a great entry point because it's one of the few times over the last 46 years that real estate is on sale. You can buy real estate at about a 20% discount right now. And I'll give you a real life example. Imagine you had $1 million property and that property was paying a 5% net income, so $50,000 a year. Well, when interest rates were at 0, 50,000 was amazing, right? Because you could only get 0.5% in a CD, so to speak. Well, when they increased the Fed funds rate to 5.5, well, now the 5% that the real estate's producing isn't as attractive because I can go get 5.5% risk-free when interest rates were at the height of the markets. So what do? They marked real estate down by about 20% over the last 3 years. So that $1 million property, the market has adjusted due to higher interest rates. You can now buy that property for $800,000. Now, also over the last 3 years, NOI, net operating income, essentially the rents, net of all expenses, have increased by about 20% over the last 3 years. So that $1 million property that was paying $50,000 a year, you can now buy that property for $800,000, but that property is paying $60,000 per year.
Is that just from the inflationary impact on rents? Like they've just bumped up the income on rents?
Somewhat due to inflation, and then somewhat due, historically rents pace inflation with real estate, but then also you have some supply and demand imbalances. For instance, in the industrial sector, which is, think of like last mile distribution. Industrial sector of real estate means anything to facilitate online shopping, same day shipping, next day shipping, 2-day shipping. Whenever you get your packages from Amazon or any other online shopping that you do, that's the industrial sector of real estate. Well, right now they're not building a lot of new industrial real estate because it's very expensive with interest rates being higher and costs being higher. But then when we look at the numbers, last year, 15% of all sales in the United States, 15% of all retail sales were online last year. And that's projected to go up to 45% over the next 10 years. So online shopping is tripling over the next 10 years, but there's not enough supply. So because demand is rapidly increasing and supply is constrained, what happens is if you own those industrial properties, you can then increase your rents. So part of it is inflation and part of it is the supply and demand imbalances that exist. Second key thing here, if we look at institutional real estate, the index for institutional real estate, it's called the NPI. So what that's doing is it's tracking every property, all the institutionally owned properties. But if you look at the volatility as measured by standard deviation, typically it's very low. So you're going to have consistent returns. So if we look at the stock market, we all know that stock market can go up and down. It's pretty volatile. So you have about a 20 on the standard deviation. Private institutional real estate's about a 2. So it's going to, on average, be about 10 times less volatile compared to the stock market over a long period of time.
And just to clarify on that, that's just the ups and downs, right? Like how big is the difference between the ups and the downs? Where we know that stocks are more like a roller coaster ride. A 2% in standard deviation would feel more like a monorail, where you're going up and down a little bit, but not a whole lot. And then you look back and you realize you've gone up quite a ways. So
exactly. So the key is we can see stocks. If we look at kind of our risk reward, stocks give us the highest return, but we're also experiencing the highest amount of volatility. Bonds give us the lowest returns of these 4 asset classes, but also the least volatility. And then if you look at institutional real estate, it's still giving you a high return, but also coupled with lower volatility. So, what the nerds would say is if you look at the risk-adjusted returns, if you're looking for assets that are generating good return with lower risk, this northwest quadrant, so to speak, that's why the large pension funds are investing in institutional real estate, is because you can generate these higher returns, but also with lower standard deviation over the long time. Quick note, though, we still love our equities, right? Because they do give us our highest return. As you guys probably teach, the key with equities is do not sell. Everybody's circumstance is different, but technically, historically, if you sell when stocks are down, that would hurt your performance. So I think it was Warren Buffett that said stocks are like soap. The more you touch them, the smaller they get. So the key there is you want to hold them for a long period of time, right? Right, Brian?
well, and where we work with a lot of retirees and people who have really already accumulated a lot of their wealth, this conversation is really great because that ability to just weather any storm with endless time is not really a lot of our investors, right? And so anything that we can do to drive down the overall volatility and still maintain a strong rate of return that will keep pace, if not outpace inflation, is definitely something we should be looking at.
Well said. Couldn't have said it better. Brian, as you mentioned, if we do have inflation over a long period of time, this chart is just showing that real assets, specifically real estate, tend to outpace inflation. So as we have inflation, typically the value of real estate and also the rents associated with real estate go up to pace inflation. So rather than just sticking your money under the mattress, a lot of the institutional investors like real estate because it's one of the asset classes that has typically exceeded the pace of inflation historically.
And is there any correlation or comments that you would make in regards to inflation and mortgage rates and how that's affected the real estate market?
Yeah, so it's kind of interesting. Usually inflation helps real estate. Technically they're printing money, right? So there's more money in the system. So the more money that's in the system, on average, people are going to have more dollars in their hands to buy real estate and to pay rents. So typically real estate does really well when we have inflation. Now, when rates go up significantly, that could have a negative impact. But sorry, my screen just did something weird. So typically, if interest rates go up significantly, that could potentially have a negative impact on real estate because the yields of the real estate are now less attractive compared to what's available out in the marketplace. So as typically what happens is if rates are going down, the value of real estate is going up, because if you're getting your rents from the real estate and those rents are increasing every single year, if interest rates are going down, that makes your real estate more attractive. So inflation, typically good. Interest rates going up, typically bad. Interest rates going down, typically good. So if rates are coming down, that would also be another good case to invest in real estate before rates start going down right now.
What are you seeing right now on trends in regards to mortgage rates?
Mortgage rates are right now, they're staying flat for the most part, and then they're starting to come down. I would say that the key with private real estate is we're not talking about homes. We're not talking about single family homes. We're just, in terms of private real estate, again, we're typically talking about other asset classes of real estate, the industrial asset class, multifamily, so large apartment buildings, which we like right now because there's a housing supply shortage in the United States. So depending on the city, we like multifamily. Storage is another area that we like. Cold storage is an area that we like. Think of food storage. When I was a kid, all we had we had peanut butter sandwiches, and we had Pepsi, and we had the marshmallow stuff that stays in your cabinet for 100 years. But because people are eating healthier, if you think of vegetables, fruits, healthy meats, typically those foods need to be refrigerated very quickly. And one thing that's interesting is we don't have enough food storage in the United States. So if you own food storage facilities, you have a lot of ability to increase rents, and your property values are on average increasing as well. So that's just another little interesting pocket of real estate. Also, regular storage with an aging population, more people moving, with the baby boomers, if we have folks passing away, we have lots of people inheriting all that stuff, and they're putting it into storage. So storage is another sector that we like. So just to give you guys an overview of the sectors of real estate that we like currently, industrial, which is all the online shopping stuff. We like apartments. We like storage. We like food storage. Just to name a few of kind of some of the sectors of real estate.
I think that's one of the biggest benefits to this private real estate opportunity, is that it's not as easy for the average investor to go out and buy a multifamily, large apartment complex, let alone to diversify across apartment complexes in multiple cities across the country, jumping into cold storage, jumping into storage facilities, industrial sector, real estate, things like that, where you guys are doing it on such a large scale and can even move around within sectors as it makes sense. If industrial closes up and you see another opportunity, maybe in warehouses or something else, I mean, you can, or you know what I mean? You can adjust much easier with large amounts of liquidity and large amounts of deal-making opportunities versus the average investor.
Yep, that's absolutely right. Yep. So as the winds of real estate are changing, if there's a sector we don't like, we can quickly pivot into, like for instance, I think 10 years ago, almost half the portfolio was in office, and office was coming to the end of a bull market. Typically office tends to go in like 15-year cycles. So 10 years ago, we started completely selling out of office in the portfolio, which is, very easy for us to do. So as of like a few years ago, office was virtually eliminated from the portfolio. And we all know that office has gotten hammered over the last 5 years, but the investors in our fund specifically were fairly insulated from office because we were ahead of the game in terms of selling our office holdings and then buying more of the industrial holdings. So just to give you guys just a general overview of the Blue Rock Fund. To Brian's point, you're highly diversified. It's not like you just have one rental property. Just within our portfolio, there's going to be 6,100 properties and 302 billion dollars of actual real estate in the portfolio. So you're going to be as diversified as you could be here. So just to sum up just to sum up some of the key benefits, number one, you get access to only through Brian and Dan, you get access to investments like private real estate. Long-term average return has been 8.5% to 9% annually. You get a combination of dividends plus accumulation. And there's also significant tax advantages to real estate as well. And then lastly, it's had lower standard deviation, lower ups and downs, kind of in that consistent asset class. So if you're hoping to have a nice retirement with good investments that have performed well over time and haven't had the crazy ups and downs, that would be one reason to consider the private real estate as part of your investment mix.
Awesome. Well, Matt, thanks so much for being on with us. Any kind of final thoughts that you'd have, generally speaking, in reference to the value of real estate or anything else?
Just that now is a good entry point. In 2008, real estate was marked down. Private real estate was marked down 25%. And then the next 12 years, it was up 341%, meaning 100,000 would have increased to $441,000 in 12 years. So now we're at another time frame where real estate's been marked down by about 20%. So kind of the catch 22 is when real estate goes down, people don't want to buy it, right? In 2009, 2010, people didn't want to buy real estate. And that was probably the best time in the history of the country to buy real estate. And now we're sitting at that same exact precipice where real estate is discounted. And we see people right now don't want to buy real estate because it's down in value. But theoretically, now is the time to buy real estate because it's down in price. So sometimes having the guidance of a financial advisor can kind of help you, maybe identify some of these opportunities to buy assets at a discount.
Yeah, you bet. Awesome. Well, thank you so much. We appreciate that. I love taking a deep dive into specific assets and opportunities, really, especially ones that serve retirees and people who are kind of in a different phase of life, than just trying to grow at all expense, grow at all standard deviation or risk, if you will. And so appreciate what you bring to the table and your expertise and Blue Rock in putting this together and so we can understand this stuff, this private real estate sector a little bit better. We are going to wrap up today, but we wanted to announce next month's. So next month, we're going to be meeting again for Elevánt Insights on October 15th at noon, like we always do. And we're excited because we have a guest speaker in a local CPA. Shauna Howe is going to be joining us. And we are going to take a deep dive into breaking down the new One Big Beautiful Bill Act that was passed. And man, if there's been anything that's been passed in the last 10 years from a regulatory standpoint that has helped retirees, man, this is it. I mean, there's a lot of really cool things that are coming into play for people in their later years that we're going to be able to take advantage of. And so tune in for that. Again, October 15th at noon, Shauna Howe breaking down the One Big Beautiful Bill Act and what that means for you. So again, until next time, we appreciate the trust that you extend to us. We don't take that lightly and are so grateful for the opportunity to do what we do. So until next time, we will see you, and thank you so much.